the property management industry, fair housing offenses are considered especially troubling. In the United States, a dedicated fair housing attorney, Leslie Tucker, provides case explanations and best practices. These are some cases.
Hello, everyone, and welcome to the Fair Housing Insiders Case Files, Episode 5, with Leslie Tucker, the principal of Williams, Edelstein, and Tucker. I'm your host, Jonathan Sarr. Leslie, this is an interesting case. It's one that highlights that fair housing applies, has a greater reach than just housing providers. So can you share with us how a bank found itself with hefty fines?
Yeah, Jonathan. This case is against a bank, as you said, that the Department of Justice alleged participated in illegal redlining. Specifically, the lawsuit alleges that in creating the defined area that the bank operates in and serves, the defendant bank completely omitted Philadelphia County, which has a majority Black and Hispanic population. And this was kind of looked at as strange and was given a special attention because several of the bank's branches were located very nearby the border of Philadelphia County. So it was, essentially deciding not to serve this very large area that was very, nearby their branches. So they also found and alleged in this complaint that for the branches that were located nearby to Philadelphia County, in other words, those that were located kind of nearest the majority Black and Hispanic census tracts, that they alleged that the bank employed only one loan officer to cover a total of 7 different branches. So for those people that were serviced by those banks, it was hard for them to even work with anyone to get a loan because there were so few employees to work with them. They also alleged that the bank didn't hire or employ any non-white or bilingual employees during this particular period of time, and even alleged that their marketing efforts were problematic. For example, the bank's website mentioned that it served specifically only suburban Philadelphia markets rather than the general Philadelphia market as a whole. So ultimately, the Department of Justice, their investigation concluded that these practices resulted in discrimination on the basis of race and national origin, because it excluded Philadelphia County residents from being able to apply for home loans or really get any sort of credit opportunities. The case ultimately settled, and the settlement terms are extensive, as you would imagine in this type of wide-ranging case. The bank was required to invest almost $3 million in a loan subsidy fund to ensure that these particular neighborhoods would have access to credit opportunities. They had to spend a lot of money on community partnerships, over $100,000, and $250,000 on advertising, outreach, education sources, and making sure that these communities were educated in what their rights are. They had to, hire new loan officers. They had to conduct market studies to kind of assess what the needs are of these minority neighborhoods and neighborhoods of color around them. So it was very costly in the end. But ultimately, when you're dealing with this type of, allegations of inequities and how long this had been going on, this is kind of the price that you would expect to pay.
Yeah, very, very interesting case. Lots of detail, and I'm sure that puts a lot of banks maybe on notice, but it begs some questions. Why do mortgage lenders fall under the Fair Housing Act?
Well, under the Fair Housing Act, it is illegal to, and this is a quote, to discriminate against any person in the terms, conditions, or privileges of the sale of a dwelling because of, race, national origin, and other protected categories. So not just housing providers, are covered by the Fair Housing Act. So any institution that's involved with funding of housing is also covered, which obviously mortgage lenders would fall under that category, as they are directly connected to the purchase of a dwelling.
Got it. Okay. Thank you for that. So could there be a legitimate business reason then, for instance, lower home prices, that banks exclude areas from their services?
Well, Jonathan, I don't work in banking. So potentially there could be legitimate business reasons for doing that. Mm-hmm. But it's important when kind of establishing your, your service area, your market area, that it be inclusive. And it's important to know kind of who is in your market area, who's living within the area that you service, and who is benefiting from your programs. Because even if you institute or if you have a business reason to exclude certain areas, if it looks like there's a disparity, then you could be the subject of an investigation, just like this bank was.
Got it. Okay. So how could a bank ensure then that they are in compliance with fair lending practices?
Well, it's important that if a bank is not already aware of who it is lending to from a wide lens, that assessments are done. And maybe that could be an internal process. Maybe you hire a third party to do those assessments. But it's really, really important that you have the big picture of who you are servicing. Because, again, if there is a disparity between your market group and who you are actually giving loans to, that tells you that you need to do something different regarding, your marketing efforts, who you are reaching out to, the areas that you're servicing. And, one of the allegations in this case actually was that they did receive assessments that told them there was this huge disparity in who they were servicing, and yet they still didn't make those changes to be more inclusive. So it is important that banks are aware of that.
Got it. All right. Very good. Thank you for your explanation of this case. And thank you to everyone who's tuned into our episode today. This has been episode 5 of the Fair Housing Insiders Case Files. Take care, everyone. See you soon.